Welcome to the Keiser Report. I'm Max Keiser. Whiny rage quitting. That's a new one, right? Whiny rage quitting. That's how Bram Cohen, creator of BitTorrent, described Mike Hearn's hissy fit upon quitting as a developer of Bitcoin to join up with the private blockchain being created by the 40 biggest banks on earth. Yeah, the guy's a traitor, and he's a rage quitter. And Stacy, what's up?
Well, we're joined with Simon Dixon here, of course, because we want to talk about this story and leading into some other stories related to these very same big banks that Mike Hearn is now working with. Whiny rage quitting is, of course, how I see the 2007-2008 liquidity and financial crisis. Now, first, I want to look at the New York Times, one of the sort of basic supporters of those sort of big banks. Bitcoin believers' crisis of faith. Here was the article about Mike Hearn's quitting as a core developer of Bitcoin. And, you know, it says straight away that he's so furious with this Bitcoin and what's going on there that he's took a new job at a new startup. Third paragraph in the article. Here's the rest of the article. Okay, look how long it says it takes to get to the fact that so-called that startup, that innovative new startup, is actually, look at all this article, before they tell you that it's R3.
What?
Before they tell you it's R3.
You mean they go through all this text and all this print over there at the New York Times before they get to the actual point of the article? How unlike the New York Times to be deceptive?
There. The last, very second to last paragraph before they tell you it's R3. I was reading that article thinking like he was joining a new innovative startup, something more exciting. And then you get R3. My God, that's like the big JP Morgan.
Right, Simon Dixon, tell us about R3, a little bit about R3. Simon Dixon, from the co-founder, lead investment advisor to Bitcoin Capital, the co-founder of BnkToTheFuture, one of the most preeminent investors in blockchain Bitcoin technology of this century. Simon Dixon, tell us about what's happening here.
Okay, for the record, let's get the real story.
Yeah.
For the last year, the banks have come along and said, hey, you know, we discounted Bitcoin, we ignored that thing. It turns out that it's the highest performing currency of 2015 and the transaction volume is higher than ever.
Point number one, best performing currency 2015 and the transaction volume never been higher. Point number two, please continue.
So then they come along and said, well, let's rebrand Bitcoin and let's call it the blockchain because everyone seems to be talking about that.
A rearguard action because they missed the initial burst because they were too stupid to know what it was. So they said, oh, we don't, Bitcoin, what's that? We'll call it blockchain as if we know what we're talking about. That's point number three. Continue, please.
And then they said, but actually there's a big problem. If we tell everyone about the blockchain, they might start using Bitcoin. And if they do, that makes us pretty irrelevant in the future of many of our markets. So what we're going to do is we're going to take out all the features that make it, you know, for consumers to be able to send money all around the world globally are virtually free and audited by outside parties, and all of the features that make it secure and game-changing for consumers. And let's use it to make some cost savings. So they
for the banks.
For them, that they're not going to pass on to the consumer.
Right, they want to centralize this technology as opposed to Bitcoin, which is decentralized. So here we have a guy named Mike Hearn who says he's on board with the Bitcoin revolution, which is decentralized, but decides, you know what, I think that a centralized system with R3, where they scoop out the costs for them and continue on in their fraudulent ways, is for me. I mean, that's the very definition of a turncoat, of a traitor.
Well, and to be fair, I've encountered them myself. But there are a lot of sort of troll-like sort of people who dox you and get a little bit crazy overboard. Young guys who probably live in their mother's basement or attic and are a little bit. They were sending death threats to him. So I think this is part of the reason why he got so angry and decided. Just like the debates that happened in early America, by the way, between Alexander Hamilton and Thomas Jefferson, whether they wanted a centralized or decentralized system, a guy who's experiencing the full force of a decentralized system of young guys from their mother's basement sending death threats.
This is why I say bring back dueling. dueling should be brought back. To have Mike Hearn and some other clown go down there at 30 paces and see who blows the other guy's head off. That's the way to snuff out this angst, this
That's a little bit overboard.
No, dueling is great.
What's your next point?
Well, we got to end the story, and so R3 comes along, and they put together a consortium of 42 now of the largest banks in the world, and said, right, well, let's take ownership of this blockchain.
Yeah.
The financial institutions are all filing patents for Bitcoin and their versions of Bitcoin and blockchain.
Yeah, JP Morgan's filed like 100 attempts, right?
Yeah, and
they keep on being denied.
Well, Bank of America has also filed many patents, but they were able to do this, in the P2P file swapping arena by claiming copyright infringement and patent infringement. And I think that's where the battle ultimately will go.
Now, I want to look at just two headlines about these big banks, these 42 big banks, and what the world they've created. And here they're saying they want to get into the blockchain. And the Bitcoin blockchain is the ultimate in transparency. Every single transaction that happens, you can see it. Anybody on earth can go look at it. Well, Nobusu, financial crisis was planned to rescue bankers. So this is a tycoon from Taiwan. He runs a shipping company, and he is named Nobusu, and he's suing RBS because RBS, Royal Bank of Scotland, basically did a margin call on him in 2008, $85 million. It caused a lot of strife for his company, his shipping company back in 2008. But he's been obsessively researching this. And he comes to this. Nobusu comments, the financial crisis was not some kind of unfortunate accident. Having read Mr. Bernanke's latest book, Hank Paulson's On the Brink, and the official financial crisis inquiry report, it is clear and worrying that governments have no mechanism for searching the balance sheets of companies that hold enormous life or death power over our societies, and that inconceivably massive financial institutions such as the New York Fed have no real system for auditing themselves. So he's convinced the $85 million, which is a perfect round number, so he doesn't know why it was like such a perfectly round number. He believes it was in order to keep AIG afloat because it was coincided exactly with that.
Well, remember Hank Paulson during the 2008 congressional hearings, they came up with $750 billion to bail these people out, which is a number they pulled up out of the hat.
He said
really.
he confessed that. He said he just made it up.
Right,
but
so
here, what do you think about this? These massive financial institutions, there's no way of auditing themselves. But here's Mike Hearn, who worked on a beautifully auditing system, a self-auditing system, now wanting to join one of these sort of organizations who have no way of knowing what they hold.
Yeah, so you've got two ways of doing this. The first one is you could use the Bitcoin blockchain, which is audited by hundreds of thousands of computers all around the world that are all incentivized to audit and regulated by mass and code. Or you could take what Mike Hearn's probably about to be a part of building, which is a private blockchain where 42 banks have to try and be honest with each other. And history has shown that when you have humans trying to be honest with each other, doesn't matter what the technology is behind it, it'll be used in a way where the auditor, whether that's KPMG or Deloitte or any of these large auditors, can rig the system.
Look, here's what I see. I got to make an appointment. It's a statement here, is that the banks have run out of fuel to fuel their fraud. Because interest rates are down near zero, quantitative easing programs are no longer working. They need a new source of funds to fuel their fraud. If they can reduce the cost of their back office by using blockchain, that'll free up billions and billions of dollars to continue the fraud. And that's why this is an important fight. The Satoshi Nakamoto and Bitcoin came around in 2008 after the last major collapse. Now we're in a new major collapse.
Well,
and this guy, Mike Hearn, is now saying, you know what? I support fraud. I'm going to go work with the fraudsters.
I think it's a little bit more something than that. The banks have no problem whatsoever of stealing money. They don't have any problem getting profits from
But to roll
everybody.
over that fraud, which is extended and pretended, requires cheap rates, and we've come to the end of a cheap rate cycle.
What I see, and you could disagree with me, but I see it as the fact that they saw Bitcoin and blockchain getting bigger and bigger and bigger, and they didn't want a competing transparent system because they knew if a customer had the option of going to a transparent system and society had the option of going to a transparent system or an opaque system like the one we have, where they profited hugely. The banks have way more money. Goldman Sachs's Lloyd Blankfein and JP Morgan's Jamie Dimon are now billionaires. They are billionaires because of their opaque system. Had we known how much fraud was committed, we would not have handed trillions of dollars to them. I think they benefit from a very opaque system. They want to make sure they buy up all the technology and the patents, get their patents, and make sure shut this system down, shut this transparent system down.
Yeah, and I think this ties into the end of the story, which is right before R3 announced their blockchain and what they're doing to be innovative. They took Mike Hearn, they hired him, they offered him obviously a very competitive package compared to what he could get with Bitcoin. I don't know that, but that's my guess. And right before he left, he puts a blog out there saying Bitcoin has failed, it's over. Now, the real story is transaction volume is getting higher than ever. There was a conference called Scaling Bitcoin, and all the miners, all the developers got together.
You were there.
Put together, I was there.
Yeah.
And they put together incredible solutions with some of the greatest minds in cryptography in the world of how they're going to scale Bitcoin, because we're now at a phase where this is really big.
But Mike Hearn wasn't there. He didn't attend.
Mike wasn't there, no.
This reminds me of that young woman that they got her to resign on air. She was a journalist on RT.
Well, but
before that was all planned ahead.
Yeah, but I think in also, going back to this banking system that is opaque, here we have a story, a brief headline from Zero Hedge, and it says exclusive Dallas Fed quietly suspends energy mark-to-market on default contagion fears. So Zero Hedge, and we might continue this on in the next episode of Keiser Report, but in the last minute here, they say they have this information that the Dallas Fed is actually preventing banks, and they just announced their earnings. And remarkably, despite the collapse in oil and despite their trillions in exposure to fracking, they have very few distressed debts in the fracking sector. And it turns out Zero Hedge believes that the Dallas Fed is telling them not to do that because of financialization, because of the opacity of the sector. They're afraid that this is the next subprime and it could crash the financial system.
Yep, and it looks like another example of 2016 seems to be the year that all the markets are imploding. It seems that we're back at 2008, a lot worse.
And the banks who have R3 don't want you to have an alternative to go to. They don't want a ready-made system to go to.
Of course not, no. And that's why, there's going to be lots of capital going into Bitcoin this year, is my forecast.
Some people talk about the new Cold War. I think we're in an era of the new Code War. So you've got banks versus Bitcoin, the new Code War. And if you're not on the side of Bitcoin, then you're on the side of centralization and dictatorship. That's all the time we have. Simon Dixon, thanks so much.
Thanks for having me.
All righty. We got to go.
I'm rage quitting. I'm using this opportunity right now to hijack this show, and I'm going to quit unless Max gives me 100 Bitcoin.
100 Bitcoin? Oh, my God. Prices are going up. All right, well, stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Stephen Kendal. He's an investor where fundamentals, technicals, and social media meet. He runs a quad server-based program tracking high-volume changes over 18,200 stocks on UK and US markets. Steve, welcome to the Keiser Report.
Hi, Max. It's a pleasure to be here.
All right, so this is a model. First of all, this is a model of markets. You track tens of thousands of securities. You look at them in real time. You look at historical patterns. This is a model of securities as they exist in the financial universe. This is the financial universe, correct?
100%. What we've got here, Max, is it's effectively what I've tried to do is take the whole globe, is take the whole world market. So we've got a combination here of stock markets, we've got a combination of equities, we've got a combination of commodities, and also effectively countries. It's the whole $275 trillion.
$270 trillion universe. This could be China, this could be the U.S. stock market, this could be agricultural markets. It's all represented here.
It's the whole lot.
We've seen in relative modern history, particularly going back to the late 70s, early 80s, the advent of the options volatility formula that introduced the world into something called derivatives, what Warren Buffett calls weapons of mass financial destruction. So here we bring in, Steve, you've got the derivative wrecking ball, essentially, that you can put right here at the top. And what year are we here to give us an historical kind of reference? This would be the early derivative markets, and you see that derivatives are are destabilizing the system. They're swinging out there. They're unregulated, correct?
Absolutely, 100%. This is effectively the sort of like the pre-2000 crash, the pre-2000 where the derivatives market was effectively, it was starting off. You know, you've got your credit default swaps, you've got your mortgage-backed security guarantees, you've got all the various different derivatives, which is in theory nothing more than a leveraged futures bet, something that's going to happen in the future.
It's a leverage bet in the futures market in order to mitigate risk today, adding risk to the future.
Absolutely.
All right, so we saw right there, I don't know if people caught it, but the derivatives wrecking ball knocked over this blue cylinder here. This was 1987 crash. I was working at Oppenheimer on Wall Street at the time, and you could see little Max Keiser represented on this little ball screaming on the way down. Oh my God, it was so dramatic. But then they came on the quantifying, the quants, as they're called, quantitative analysis and deep technical programmers, and they developed a patch essentially to allow for not any reform of the banking system,
that's right,
not any jailing of corrupt bankers, but they decided they created a bigger derivatives ball. That was the result of all that. Am I correct, Steve?
Absolutely. Now we're effectively into pre-2008. So the original one, or the first one, was 2000, pre-2000. We're now in 2008, and of course, effectively, it's exactly the same principle. The markets are exactly the same. You know, you've got your property markets, you've got your commodities market, you've got your trading markets. Everything is exactly the same. The only difference is now is that the derivatives market, the futures bet, has got bigger.
Right.
And again, unregulated.
And we hear anecdotally at this time where people are talking about the shadow banking system being bigger than the visible banking system.
Absolutely.
So if the global markets on various exchanges might be, if you add them all up, it could be 20 trillion or 22 trillion. They're saying, well, the shadow banking system is actually 25 trillion or 35 trillion. And you're saying that out there in the shadows, it's swinging around, it's unregulated, it's a huge risk ball. Essentially, it's concentrated risk. I always say, I'm curious what your thoughts are, that when they invented derivatives, it was like Einstein's E equals mc squared, to the degree that for the first time, energy and mass were separated, and you could trade on energy exclusively and create an atomic weapon. Here with the derivatives market, when they came up with the options volatility formula, they could say, well, risk is separate from reward. We can trade risk separately, we can package risk, we can leverage risk, and you end up with this enormous derivatives ball that's unregulated, and it's just swinging out there wildly. And what time frame are we talking here?
Well, effectively, to go from the original ball to this ball is effectively 8 years. You know, from 2000 now we're up to now 2008.
Heading into the subprime crisis.
Heading into the subprime crisis,
which is a crisis of more derivatives.
Absolutely. I mean, effectively, the principle is exactly the same. The only difference is the markets have stayed exactly the same. The difference is that people have pushed all the risk out into the future. So they've taken the risk for today and they've pushed it further and further and further out.
They had a lot of people who couldn't afford to pay mortgages because they had no jobs.
Absolutely.
But they gave them $500,000 or $1 million or $2 million loan anyway in a mortgage, thinking that, well, over the next 20, 30, 40 years, it'll all work out somehow.
Absolutely.
And it blew up because this went swinging down. So the subprime market, you know, I'll put the subprime market as the yellow column here. Oh my God, there it is. Then Hank Paulson goes in front of Congress and says we need $750 billion to bail out this derivatives nightmare that we have no control of whatsoever, but we need the money anyway, or we're going to let this thing swing wildly again,
Absolutely.
and we're going to knock somebody else over.
Absolutely. And not only that, until these markets were effectively nothing more than just a trading market. It's a buyer, it's a seller at a particular price today. The derivatives...
All right, stop, because let me interject something there. What you're saying is these markets, buyers and sellers, financialized instruments, there's no underlying profits. There's no underlying manufacturing. There's no underlying gold standard and mercantile trading globally. It's just pure bets, leverage bets, and this is where the action is. This is why Jamie Dimon and Lloyd Blankfein are billionaires, because they get a fee on this big frickin' ball.
Absolutely.
They're big swinging balls, and they get a fee on the big swinging ball, and they knock things over. And when they knock it over, they go to the government and says either give us some more money to bail these things out, or we're going to swing this ball even bigger. So now we're at 2008, right?
So now we're at 2008, and of course we've now got the crisis. We've got the credit crisis of 2008, where effectively you've got the massive big bailouts. And of course, you know, the derivatives
$15, $20 trillion worth.
$15, $20 trillion. But again, the actual markets, the global markets, it's exactly the same as it was in 2000.
Did they reform the markets?
No.
Did they put bankers in jail?
Absolutely
Except
not
for
at all.
Iceland.
Absolutely.
Iceland's not even on this table. I don't see Iceland anywhere here.
Yeah, effectively, what you've got here, the individual markets, the commodities market or the asset markets, you would have reform in those markets, but what was actually causing the problem was the actual unreformed derivatives market, which effectively dwarfs the whole of the market in 2008 by about 3 times.
Excellent point. So you're saying, yeah, there was a token and lip service paid to reform, maybe the Chris Dodd or Dodd-Graham bill, the various other initiatives that were put in place, but they don't touch this huge gargantuan market. So let's move forward in time.
Okay.
So this, of course, we're moving out of 2008. Nothing was changed. Barack Obama is now the president of the United States. And he, of course, in the crisis, gave carte blanche to the Wizards of Wall Street. He let Larry Summers, Robert Rubin, Alan Greenspan, Ben Bernanke, the same guys who created the problem. He wrote him a check for $20 trillion, and what did they do? They said, yeah, baby, this is what we're going to do. We're going to create the biggest freaking derivative nightmare ever the world has ever known. Let's put it in there, Steve. It's so big. I'm just destroying the global economy, just hanging the derivative ball of debt, swinging. Oh, my gosh, there's clip it on there. And so take us down to what's happening historically.
So again, just recap, going back to the small ball, which was effectively 2000, which was the dot-com industry, the dot-com era. You know, we were just starting to get onto the internet. We were just starting to share on the internet. And of course, then in 2000, pre-2008, was the adoption of smartphones, was the adoption of mobile communication, was the adoption of effectively social media.
Okay,
people
so
were starting to talk.
There's a technology theme in your work
100%.
as well. There's
Absolutely.
disruptive technology is coming at the same time of these huge
Absolutely, yeah. So now we're at 2016. So the first one was 2000, the second one was 2008. We are now today. And what has effectively happened now? We've got a derivatives market, which is effectively a global derivatives market, which is effectively now 1.5 quadrillion, which is $1,500 trillion. Effectively, that is in theory 6 times the actual global trading market. So if you add up all these markets, which is effectively what the real asset is, you've now got a derivatives market,
Yeah, I
which
mean,
is
this is
swinging.
not a bad, you know, if I put all these in my hand, thusly, I'm driving my director crazy here. But, you know, this is the world market here in my left hand. This is the global derivative market. I mean, this is, you know, about 6 times as big. I mean, that's not
Absolutely.
a bad, not far off there.
Absolutely.
Okay.
Absolutely.
Keep going. You're on a roll, Steve.
Absolutely. Thank you. And the fact that it's actually 6 times, I strongly believe that a derivative, because it's a leverage bet of a future event, it's a 50-50 bet. You know, if you take a leverage bet, you take it with a counterparty. So you will put your money on the table, they would put their money on the table, not forgetting it's leveraged.
Yeah, but they're bankrupt, and of course it blows up. Let's flash forward to today. There's a technology on the horizon. We got about 2 minutes, which you think is going to usher in another huge, gargantuan. Talk about it.
Absolutely. At this moment in time, this is totally unregulated. I strongly believe in 2016, blockchain technology will be adopted. It will be adopted. Blockchain technology will be adopted, and it will effectively allow the whole derivatives market to be checked, accountable, monitored
for the first time.
For the first time ever.
And this will usher in a huge crash.
Absolutely.
Because all the fraud is squeezed out of the system, and that's what's keeping the system alive is fraud.
Absolutely.
And this will be driven by the urgency of the ongoing crisis that we're in right now, today.
Yeah. And when I say a crash, I don't mean a crash across the whole financial sector. These individuals here will go up and down because effectively what you've got, the derivatives bubble or the derivatives bomb is pushing one asset up and bringing one asset down. And what this will do is it'll level everything out. Just to give you an example.
Okay, so what's the most abused, manipulated, underpriced asset in the world today?
Gold and silver, 100%, without a shadow of a doubt.
So we're talking price targets of gold and silver, several multiples of their current
Several
price.
multiples. You only have to look at the short position on gold alone.
People have made a negative bet with borrowed money.
Absolutely. 300 to 1. For every ounce of silver in the ground, in the trade, there's 300 being sold off.
Steve, we're about out of time.
Okay, thank you.
So we got to say goodbye.
It's been a pleasure, Max.
But thanks so much for being on the Keiser Report. We'll have to have you on again soon.
We'll look forward to seeing you again, Max. It's been a pleasure.
All righty. Well, and that's going to do it for this episode of the Keiser Report with me, Max Keiser. I'd like to thank our guest, Stephen Kendal. If you'd like to get in touch, please tweet us at Keiser Report. Until next time, Max Keiser saying, bye, y'all.